On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Thomas Martin. He is the Senior Portfolio Manager for Globalt Investments located in Atlanta, Georgia. Thomas, Happy New Year and welcome to today's Jobs Day. I have to get your thoughts, your knee-jerk thoughts right now on the number that came out. We were expecting 73,000. We saw 50,000 on the headline. And then we have unemployment has actually dropped slightly. Do you believe that this is enough evidence to really get the Fed to move and cut rates again when they meet at the end of January?
Well, Todd, thanks for having me on your program and Happy New Year to you. It's great to be here. And the answer to your question is no. That's the
Okay.
short answer. Is that, and it's even being shown in the futures, is that we went from sort of looking for 50 basis points for the full year, 52 now into 48. And the odds of a move in January, which were never very good to begin with, moved a little bit south. So, the number was not really disappointing. It was another one of those in the middle kind of numbers. And the room for error, it's important to know on these reports, is pretty large. It's like 130 or something. And so, 50, 60, 10 is the difference between what we got and what consensus was. Just really isn't going to be enough to move the Fed as a whole. I think what's going to be more important is just the individual members and what their perceptions are.
Well, you're right. I would imagine we're going to get quite a few dissents, like we did in the last meeting, but maybe more so with the upcoming meeting, and especially now with the change in leadership that's about to happen in the next few months with the Fed. But do you see the number? Because one of the sticky points about the narrative for the Fed cutting rates has been a weaker jobs market. I mean, do we need to see a negative number, you believe, to really get the Fed to fully push and commit to more easing, or is there something else that's out there from a macro standpoint that we may not be considering?
Yeah, I think it's important to remember that the Fed is not monolithic. It's 14 people. And yes, you do have a chair who really does have some degree of control and tries to influence it to get it to be where he wants it to be. And so the new person who will be that person is going to be important because they move it in a general direction. But they're independent people, and they have their different focuses, and some are more focused on inflation, some are more focused on unemployment. And when I talk about unemployment, really what they're worried about is a recession, because you can't have a recession with these kind of debt levels that we have and the interest costs, et cetera. You want rates to come down, but they still have to fight inflation. And there's a lot of factors that are going on right now, which are really out of the Fed's control, but which will potentially influence inflation upward. For whatever reason, you're seeing the 10-year is now back up at 420. And whether that's due to inflation expectations or just growth expectations or, the term premium, et cetera, the Fed has to be very mindful of both of their mandates, which they are. So I think that, while this data is in the middle and while the economy is fairly strong, there's going to be a reluctance to move too far too fast to lower rates.
The White House announced that the president has informed his representatives, not the House of Representatives, but I suppose investment gurus that are somehow connected to the White House. He has instructed them to buy $200 billion worth of backed securities in hopes that that's going to decrease mortgage rates, and bring, like you said, that 10-year yield lower. Do you see that actually taking place? If this does happen and they're buying 200 billion, will we see an immediate reaction and they actually see the yield curve drop? Or do you think it's just really just a step over thing and we're not even going to bother with it?
Well, it's sort of a nice idea, and the president is focused on general affordability. So he does want prices to come down. He wants, the American people to feel as though he's going to bat for them to make it easier to live, right, and to be able to buy things and whatnot. And housing is a huge part of that. But as everybody knows, there's two components to affordability in housing, and one is the price of houses,
Yeah.
which is influenced by supply and demand. So nothing to do, well, not nothing to do with mortgage rates, but the other is the mortgage rate piece. And that can come down, but it is going to be related to longer term interest rates. Now, you can move the market in fixed income by buying and selling the instrument itself. So would an initial move of 200 billion move that in the short term? Quite possibly it could, but is it sustainable? I mean, when they spend that money, where's the next 200 billion going to come from? And the issue with this one is that Fannie and Freddie, they used to operate independently. They were kind of like hedge funds, and then they got into trouble, and then the government had to take them over and kind of bail them out, and here we are. The idea is to get them to go public again, but adding these things to their balance sheet moves back towards the setup that created the problem in the first place. Not that that's going to happen again. But they have 200 billion between them that they're allowed to buy currently at this level. And that's way down from what they used to be allowed to buy, which was more like 800 billion.
Hmm.
So there is room to do that. And of course, those limits could be raised and they could move back more towards that. But, if they do that, and rates go down, then do housing prices go down? Or, because it's more affordable, does that create demand for housing, which bumps prices up? And that's the main problem, is that we need more supply of housing to outstrip demand so that the housing prices can moderate from here. So that's a very long-winded way of saying, no, I don't think this is really going to be a sustainable solution.
Interesting. Let's turn the page now. Let's talk about the equity market. So last year, as you know, we had a great year. S&P up 17%, Nasdaq up 20%. A lot of it had to do though with movement by the Fed and those rate cuts, and that provided an octane to really get the bulls running last year. This year, 2026, what is your outlook this year? Because it sounds like what you're telling me, we talked about at the beginning of the show, is that you're not expecting an easing pattern with the Fed, but what will propel stocks even higher this year?
Right. And, I think to be clear that the Fed will probably lower rates by 25 basis points. So you have a minor tailwind there. But like you said, not to the degree that we had in 2025. The main driver here is the overall economy, the strength of the consumer, and the strength of capital spending. And continued spending by the government. So C plus I plus G, and we have the one big beautiful bill, which is providing a fair amount of fiscal stimulus. So you have a lot in the general economy that can move GDP higher. And we saw GDP now estimate, and this is just the fourth quarter, and the Atlanta GDP now is 5% plus.
Wow.
So, we're talking about a fair amount of just economic tailwinds and underpinning. And you've also seen the productivity number, which was 4.9%, which is just, really quite gigantic
Yeah.
relative to where it's been in the past. And earnings growth for the S&P 500 is estimated to be 15% for 2026. And, although the pencils aren't really sharp for 2027, a similar number there. So that can drive the market higher. What we have seen, and you've alluded to, is that, the driver of the market was growth in the Mag 7 and tech,
Mhm.
and that has changed in November. Now, that's changed in the past, but they've always come back to growth in tech. And it's not to say that the market won't do that again this year. But in the meantime, with such a strong cyclical underpinning, you have more of a reason to move into those cyclical stocks and to, the value stocks, so industrials and financials and materials. And if the earnings growth can come through there, that narrows the delta relative to these other growth companies and to tech. You'll see more interest in those kinds of companies, and this rotation could continue.
The events that took place in Venezuela over the weekend, oil, it seems we were expecting a lot of trading, a lot of activity out of the price of crude oil, and yet it's just been really kind of just stable. It's been rather boring, actually. But when you look at some of the specific oil companies, companies like a Valero Energy, they're really specialized in refining heavy crude that comes out of Venezuela. Is that a sector right now that you would tell Globalt investors to actually say, okay, maybe want to really take a clear eye on this and consider a larger position in the oil industry?
Well, it's interesting that you asked that because we've had our eye on the price of oil and on the oil stocks for a while.
Okay.
We have been underweight, and of course, that's been pretty much the right thing to do as oil has come down from 80 to $100. It seems like you can't even remember when that was, but down to the 50 level. The market participants are almost universally bearish on the price of oil. And the reasons for that are there's a lot of fundamental reasons, a lot of supply,
Yeah.
increasing demand. And of course, if this comes to fruition really with Venezuela, there should be more oil put on the market. What will the other actors do, like Saudi Arabia and Russia, et cetera, in this regard? That's kind of a wild card. But with the sentiment for oil being as bad as it is, it's interesting that the price of oil really, even though it went down initially on the Venezuela news, it's come back up. So I think the jury's out there, and the market likes to surprise and punish the consensus, especially when it's been that way for a long time and it seems obvious. So I think that there is risk that oil prices go high, not necessarily for the fundamental reasons, but because it just does, because the market moves in that direction, just anti-sentiment. So we're careful there. We're observing it, and we're looking to potentially increase exposure there.
You mentioned AI earlier, and one of the things with AI is copper. And you have with the your gold and silver trade, and then copper obviously did quite well last year. Are global investors, are they asking if they should hold a position in the commodities in the metal space, or is this an area you just think it's run its course?
Well, so for our investors, just to be clear, they are in our strategies. So we don't so much recommend to them like a brokerage firm, and then we put something in their account. We have managed money, and so we have strategies that we invest in. And for our macro-driven strategies, we have had a significant position in gold and silver and the gold miners for really a number of years, and certainly all of 2025. And it was very fortunate to have that. We continue to have that position and to think that the underlying fundamentals are good. I mean, we have trimmed it back just because of the amount of increase that we've had. So it's a nice position to be able to trim into a rising price. But we think the fundamentals are still there, and we do think that copper is going to be in heavy demand, particularly if we're getting more cyclical underpinnings in the market. So we do like those. And I guess I'd add one other thing, Todd, is that one of the things that the Venezuela situation
Oh,
just really puts a stamp on is this idea for countries really across the world to become more self-sufficient and to rely on their own resources and to get those resources. So we've gone from what drove the economy for decades before, is this globalization, to a deglobalization and to more redundant types of an outlook. We have to have our own copper and our own rare earths and our own processing and our own microprocessors, et cetera. And so does China, and so does Russia, et cetera. So this is driving demand for more physical types of resources. And we see that trend continuing.
Final question for you. We are expecting a Supreme Court ruling on the tariffs. And this is good. This could be a monumental moment because if the Supremes rule against the White House's policy on tariffs, this could mean possible rebating to countries. This could cause a huge negative impact on the U.S. economy. Overall, how are you looking at this? Do you think that it's prudent to strategize and wait for the ruling? Do you think it will have a negative impact on stocks? I'm sure you're getting some calls. I know your clients are investing in strategies, but I'm sure they're concerned. I'm not saying the ruling is going to come out today either. It's just there seems to be a whisper that it will be coming out after the close today. What are your thoughts on this?
Well, so again, the short answer is that when the dust settles, we don't really expect it to have that much of an impact overall on how we're investing. But that's not to say that it isn't going to create a lot of uncertainty and a lot of movement among the players. The Supreme Court will rule. It looks as though it's, again, fairly obvious that it was really an overstepping of the power with this. And everybody acknowledges it would be a big pain in the neck to try and set things right. So there's going to be a lot of back and forth as to, whatever the ruling is, what its implications are, and then, of course, what do people do? First of all, notably, what does the Trump administration do, and what other powers do they use to continue to use tariffs? And how important are those tariffs and levels going to be? Remember that the threat was that it was going to be 50% or 40%, and now it's down to like 14% or 9%. So the impact is much smaller. And this fighting over or positioning over or using of more scarce items, like the rare earths, et cetera, versus just high tariff levels has sort of muted that. So we think that there will be noise, but we don't see really a way that we can clearly see a big fat softball pitch to play on this.
Okay, well, I know we'll be talking about it again when you come back to the show, because by then we obviously will have the ruling and we'll definitely know what the negative or positive implications could be for the markets and the economy. Thomas, you've always said you say the best. Our audience loves you. They love your comments and your editorial on the markets. And I want to thank you for joining me today, and I can't wait to have you back.
Great. Thanks for having me on. Really appreciate it. Take care.
Absolutely. So on behalf of Thomas Martin, I am Todd Schoenberger. Catch us at 12 o'clock today. We have WaveWire coming up live at 12 o'clock, and they are live at the CES. You won't believe what they have to say, what they're actually exploring on the electronic side. A lot to talk about then. So until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.